Hello everyone and welcome to All About Trading channel. In this video, we'll explore a powerful trading strategy that combines key elements for successful decision making in the markets. We'll dive into the world of the RSI indicator, market structure analysis, support and resistance concepts, best bullish and bearish candlesticks for precise entry, as well as effective risk management techniques. By fusing these essential components together, you'll gain a comprehensive framework that can guide you through any market condition. Whether you're a beginner or an experienced trader, this strategy will equip you with the knowledge and tools to make informed trading decisions and increase your profitability. Understanding the market structure is a crucial aspect of successful trading. It helps us identify the overall trend and potential trading opportunities. Let's explore the three primary types of market structures: bullish market, bearish market, and ranging markets. First, let's discuss the bullish market structure. In an uptrend, we see a series of higher highs and higher lows. Each new high is higher than the previous one, indicating strength and buyer dominance in the market. Identifying bullish market structure allows us to focus on buying opportunity, as the upward momentum suggests higher prices in the future. It's important to align our trades with the prevailing trend for higher probabilities of success. Now, let's move on to the bearish market structure. In a downtrend, we observe lower highs and lower lows. Each high is lower than the previous one, signaling weakness and seller control in the market. Recognizing the bearish market structure helps us identify potential short selling opportunity, as the downward momentum suggests further price declines. It's crucial to avoid buying against the prevailing downtrend to mitigate risks. Lastly, we have the ranging market structure. During periods of consolidation or indecision, the price moves within a defined range, forming a series of similar highs and lows without a clear trend in either direction. Identifying ranging market structure is important for range trading strategies, where we can take advantage of buying near support and selling near resistance levels. Traders often use range-bound indicators or oscillators to navigate these market conditions. By understanding and identifying these three market structures, we gain valuable insights into the market's behavior and can align our trading strategies accordingly. Now, let's move on to exploring support and resistance levels. Support and resistance levels are key concepts in trading that help us identify areas where buying and selling pressures converge. They are not simply specific price levels, but rather zones or areas on a price chart. Let's dive into understanding support and resistance and their significance in trading. We can identify resistances by observing areas where the price has previously struggled to move higher. When price approaches a resistance zone, it is an indication to be cautious of potential reversals or slowdowns. Supports can be identified by observing areas where the price has previously found buying interest and bounced higher. When price approaches a support zone, it is an indication to watch for potential reversals or price bounces. Support and resistance zones can also change their roles over time. A previous resistance level, once broken, can turn into a support level and vice versa. This phenomenon is known as the change of role of support and resistance. When a resistance level is breached and the price moves above it, that level can become a support level as buyers now see it as an area to enter trades. Similarly, when a support level is broken, it can become a resistance level as sellers may now view it as an opportunity to sell. Support and resistance levels are created by the collective actions and decisions of market participants, including institutional traders, retail traders, and algorithms. These levels form as traders react to changes in supply and demand dynamics, market sentiment, and economic factors. Support and resistance levels are essential tools for traders. They help us identify areas of potential price reversals, plan entry and exit points, and manage risk effectively. By understanding how these zones are formed and their significance in trading, we can make more informed decisions in the market. Candlestick setups are powerful tools for identifying potential entry points in trading. By recognizing specific bullish and bearish candlestick setups, we can gain insights into market sentiment and make informed trading decisions. Let's explore some of the best candlestick setups for buy and sell entries. First, let's discuss about bullish candlestick setups for buy entries. These setups indicate potential buying opportunities and suggest a higher probability of an upward price movement. One of the commonly used bullish candlestick setups is the bullish engulfing setup. It occurs when a small bearish candle is followed by a larger bullish candle that completely engulfs the previous candle's body. This setup suggests a shift in momentum and a potential trend reversal, indicating a buy entry opportunity. Another powerful bullish candlestick setup is the morning star setup. It consists of 3 candles, a bearish candle, followed by a small-bodied candle indicating indecision, and finally, a larger bullish candle that closes above the midpoint of the first candle. This setup suggests a potential buying opportunity and a potential reversal of the downtrend. Now, let's move on to bearish candlestick setups for sell entries. These setups suggest potential selling opportunities and indicate a higher probability of a downward price movement. One commonly used bearish candlestick setup is the bearish engulfing setup. It occurs when a small bullish candle is followed by a larger bearish candle that completely engulfs the previous candle's body. This setup suggests a shift in momentum and a potential trend reversal, indicating a sell entry opportunity. The evening star setup is another powerful bearish signal. It consists of 3 candles, a bullish candle, followed by a small-bodied candle indicating indecision, and finally, a larger bearish candle that closes below the midpoint of the first candle. This setup suggests a potential selling opportunity and a potential reversal of the uptrend. Now, let's move on to exploring the timeframes and how we can use them. Timeframes represent the duration or interval over which price data is displayed on a chart. Each time frame reveals a different level of detail and provides unique insights into market behavior. When comparing higher time frames to lower time frames, higher time frames generally encompass longer intervals, such as daily or weekly charts. These time frames offer a broader perspective and help identify the overall market trend and key support and resistance level. On higher time frames, the formation of candlestick patterns and support or resistance levels becomes more significant. These levels are generally more reliable and take longer to form, representing stronger areas of buying or selling interest. Additionally, higher time frames provide a clearer picture of the market structure, allowing traders to identify long-term trends and make informed decisions based on the broader market context. On the other hand, lower time frames, such as the 1-hour or 15-minute charts, offer a more detailed view of price action and are commonly used for executing shorter-term trades or scalping strategies. Lower time frames allow traders to observe smaller price fluctuations and identify more frequent trading opportunities. However, it's important to note that lower time frames can also be more volatile and subject to noise or false signals. While lower time frames can provide entry and exit signals with higher frequency, it's crucial to align these signals with the broader market trend observed on higher time frames. Trading in the direction of the higher time frame trend increases the probability of success. Moving further, let's discuss about our main subject, the RSI indicator. The RSI is a momentum oscillator that oscillates between 0 and 100. It compares the magnitude of recent gains to recent losses over a specified period and generates a value that reflects the strength or weakness of the price movement. The RSI is most commonly used to identify overbought and oversold conditions in the market. When the RSI value exceeds 70, it suggests the asset may be overbought, indicating a potential reversal or corrective pullback. Conversely, when the RSI value drops below 30, it suggests the asset may be oversold, signaling a potential bounce or upward reversal. Let's explore some common errors made by beginners with the RSI indicator. One common mistake is relying solely on overbought and oversold levels indicated by the RSI. Beginner traders often assume that when the RSI is above 70, it's an automatic sell signal, or when it's below 30, it's an automatic buy signal. However, markets can remain overbought or oversold for extended periods, leading to false signals and missed opportunities. Another mistake is using the RSI as a standalone indicator without considering other aspects of technical analysis. The RSI works best when combined with other tools such as trend lines, support and resistance levels, and candlestick patterns. Failing to incorporate additional analysis can lead to inaccurate signals and unreliable trading decisions. Now that we have covered the key components of our strategy, let's explore how to use them effectively. The strategy aims to identify favorable trade setups based on specific criteria. We will focus on taking long positions for this video. For short positions, the criteria is the same but vice versa. To execute a long position using this strategy, we need to satisfy the following criteria: a bullish market structure, an oversold RSI, a price retesting a support area, and the presence of candlesticks that show a clear bullish momentum. Firstly, we analyze the market structure to determine if it's exhibiting a bullish pattern. We look for higher highs and higher lows, indicating an upward trend. This bullish structure provides a favorable foundation for taking long positions. Next, we assess the Relative Strength Index indicator. We want the RSI to be in the oversold area, typically below 30. This suggests that the price may have been driven down too far and could potentially rebound, presenting a buying opportunity. Once we have confirmed a bullish market structure and an oversold RSI, we focus on the price action. We look for the price to retest a support area, which can act as a floor for potential upward bounces. This support area can be identified using key horizontal zones. Lastly, we examine the candlestick patterns to determine the entry point. We see clear bullish momentum in the candles. This can be indicated by patterns such as bullish engulfing or morning star, which we just discussed, or custom candlesticks formations that show a clear bullish momentum. These candlestick setups suggest a shift in sentiment and potential upward movement. In addition to the classic candlestick patterns, the price can create custom setups like the ones on the screen. An example would be when the price forms a small range and successfully breaks the resistance of that range. Another example could be when the price forms another small range, creates a fake out to the downside of the range, and then manages to break the range's resistance. When all these criteria align, we have a favorable long position setup. At this point, we can enter the trade by placing a buy order. It's essential to manage risk by setting stop loss and take profit levels. We can set the stop loss level below the current support area. We do this because if the price reaches our stop loss level, it means that there can be more sellers than buyers and the price will probably go lower. The take profit level can be set at a next resistance level. We can set it at a resistance area above the last higher high, or we can set it at the last higher high formed. Setting your take profit level above the last higher high means you're expecting the market to continue moving further up, forming new higher highs. Don't forget about the risk-reward ratio. Aim to find setups that gives you a reliable risk-reward ratio. For example, if you're a beginner, you can watch to see if you can find a setup that gives a minimum risk-reward ratio of 1 to 3. We know, hard to find, but remember that in trading, patience pays. Remember that successful trading requires practice, patience, and continuous learning. Take the time to study the markets, analyze price movements, and refine your skills. As you gain experience, you will develop your own trading style and adapt the strategy to suit your individual needs. Consistency and discipline are key to long-term success in the market. We hope this video has provided you with valuable insights and tools to enhance your trading journey. Thank you for watching, and we wish you all the best in your trading endeavors.